Well, there's no time like the present. Let's get into it. Pref stocks, pref options, and a little bit of theory around strategies, prefs, why somewhere may have not voted for prefs, and then going over Saylor's H.C. Wainwright speech, talking a little bit about pref theory and why these Bitcoin treasuries are using the perpetual contracts to perpetual equities to buy Bitcoin. So, let's just hop into it. So, most recent AK, you can see some of the ATM usage, and as a percentage of volume, this remains high. Stretch still remains below its par value, which continues to be a problem. Stride is trading well below par, but the ATM is used in both these cases for Strife and Strike. I see absolutely no reason why you would ATM $5 million of either of these securities or $11 million of that. The much more impactful signaling to the market would be for these things to trade up in value. I see zero and the volume's so low. I mean, like, what is the point? What is the point? Why would you issue? I don't understand why you would continue to issue these things. Just stop. Build volume. Build liquidity. Like, liquidity will come naturally as people see them trade up. Like, if Stripe, the volume will follow, liquidity and volume will follow price movements. So I just don't understand. I just do not get it. And then, furthermore, this is what's kind of making me frustrated, is I want to make a bet on Strife. I think it's the highest credit quality instrument in the entire strategy capital stack. I think it's a anomaly security. I think it's very, very valuable. But if they're going to ATM it, I mean, you can't make that bet because they're manipulating the price of the security. And so that's one thing I find kind of frustrating with some of the MSTR rhetoric is, so, we'll say, some people like to say that, issuing common doesn't affect the MSTR share price.
Market data connection lost.
That's just the IBKR, sorry. But then when I posed the question,
market data connection
what
reestablished.
If Strife trades up and trades up significantly, especially in a low interest rate environment, the answer I get is, well, they can just ATM it. So you're saying the ATM doesn't affect the price of the common, but then in response to a question about the pricing of a security that's other than the common, the response to how do I change the price of the security is ATM. It just doesn't make any sense to me. Like, that's a very hypocritical, or that's a very antithetical statement. So that bothers me a little bit. Now, Strife options chain, we'll look at how they're trading now. You can see the 120 strike for January. I mean, the spread's so wide. There's literally like no volume on these things. There's a little bit of open interest because there's an ARB here with the in the monies and the current price of Strife. There's a lot of cool stuff you can do with this, so I think there will be some trades around that, and I'll get into that later. But you've got covered call selling, put selling to spike your yield. You can use the puts to lever the actual strategy. All of these are strong candidates for a different strategy. But I think really these options aren't going to be priced based on the Black-Scholes, and they shouldn't be, simply because there's going to be dynamics at play, right? Like, for example, ATM, period. The presence of an ATM on the security and strategy's willingness to change the stock price using the ATM will mean the calls will be cheaper. And then furthermore, you can create a synthetic call by buying a put and going long the actual Strife, which pays a dividend. So there's a natural arbitrage there. That setup is more valuable than a call because you're getting, or the equivalent call option, because you're getting the dividend paid to you by the actual security. So I think the puts will be very, very expensive relative to the calls for STRF, and that's going to create a huge opportunity for those looking to sell the puts, in my opinion. That's a really good trade. I think if you want to lock in, and I'll go into it later, a high yield, you can sell a put at your desired entry of Strife, lock in that yield, and then know exactly the perpetual yield which you retain upon getting assigned STRF at that given price. So I think that's a really cool way to boost, amplify your yield on STRF when you know it's a durable security. Stretch, largest IPO in 2025. I think that's big. That's pretty big info, big institutional money, but this will go later. They talk about how retail is more involved in that offering, 3.7x retail growth in SCRC issuance. And so this is, this is where the money is. It's not from retail, and that can potentially cause problems with the securities pricing. They're locked up by big institutions, and that makes strategy kind of at the mercy of those holders, but that's another question. Bitcoin per share. Okay. So Strife. You get Strife, 31% price return since launch. That, I mean, I just don't get it. Like, I don't see why that's something. They were just sold. It was just sold at a discount. I still think it's trading at a discount, but 21 million average daily trade volume. That needs to go up, but that's very impressive relative to other preferred stocks. Targeting these, I mean, Strife is the security. It's the security in the cap table. Like, Strife is what you want to own, in my opinion. Now we can look at the collateralization ratio. So Strife is 7.6%, 6x over collateralized. The target, long-term target is 10x over collateralized. I mean, why are you selling it? And this is the stuff that kind of gets me, right, as a trader, is like, so if your long-term target is 10x, and I know this doesn't account for the converts, right? The converts are right now what keeping the Bitcoin rating lower on the senior preferreds that are junior to the converts. But I mean, if you said Bitcoin rating 10x and Bitcoin rating 7.6x and you're ATMing it, it's just like, okay, like I don't know what to do here. Stretch 10x, Strike 6x, Stride 3x, very cool, all good equity, investment grade mezzanine, high quality, high yield equivalent. So it's interesting, but like I mean, like I guess that's the long term target, so you can figure out exactly how much they're going to issue, but. Like, so what are you gonna buy? Like, it's trading at right now a 450 basis point credit spread. Right now, it's trading at a 450 basis point credit spread, and so if you want to bet on principal appreciation, you have a lot of runway to do so. Like, if you believe the security is more credit worthy than it's trading on the open market, you would theoretically buy Strife and drive the principal up and the yield down, which is actually advantageous for strategy because they're getting a lower cost of capital. But by issuing more and more of the debt at prices right now, right, I just don't get it. Like, why not let Strife, why not do everything in power to decrease the float of Strife, even buy it back in the open market, drive the principal up, the coupon down, and then issue it at a lower coupon? And the optics of that are just so strong, in my opinion. So that's how I do it, but I don't run a Bitcoin treasury. I just run a hedge fund that's trying to trade these things. Stretch guidance. Okay, we saw this. 5-day VWAP at the end of the month between 95 and 99. Recommended 25 bips rate increase. So that's the recommendation for that traded range. We saw 100 bips at the end of the month. It's advantageous to the holder, so totally cool. They're trying to get that price up into the target range. I wouldn't be surprised if we see another rate increase next month. I mean, that'll be great. It's the unpredictability factors are difficult, but you know, you don't want to be a trader, you want to be a holder. There are options on stretch coming, it looks like. Midterm capital structure, and once again, you get this whole deal. That's all good. Yield curve for Bitcoin credit. You can use a rolling window of dividends to create midterm duration credit, and that's going to be an interesting market and something that's, you know, going to be interesting to watch as they build out the yield curve. And so I'm not a holder of MSTR, but I just think the implications of these credit instruments are where it's moving. Like, if you really believe in Bitcoin and what Bitcoin is and money, you can say, okay, well, like, debt isn't going to really be a thing in the Bitcoin economy, but there's going to exist a natural arbitrage between BTC and USD if you believe USD is melting relative to BTC. So this is a natural kind of ideology, or like a perpetuity is the best way to capture that deflation, the inflation of USD and deflation of BTC and price appreciation of BTC relative to USD. So, I mean, I love the preferred products. I think they're probably one of the most important things in the Bitcoin ecosystem as we see it now. BTC, USD, swap, I just think it's incredible, right? But what security would you own here? I mean, I wouldn't own anything other than Strife. Next. MSTR amplifies BTC through intelligent leverage. Yes, this is like the most important chart in my opinion, understanding MNAV. Because my foray into MNAV was looking at it from a leverage perspective. So when I was in the game, strategy had these converts, and the converts were the leverage, and the coupon were covered by the free cash flow. So it was a pure levered package, ETP called. Let's say it's an ETP. It's not. It's an operating business, but it's a levered package. And I decided that if I believe Bitcoin were going to 250K, and they had 30% leverage, then a 1.33-ish MNAV was justified. But if you believe in higher and higher Bitcoin prices and sustained leverage throughout the total adoption phase of cycle of BTC, then you can really justify actually a quite high premium for that actual amplification of leverage. The problem is, this is 30 leverage, 30 BTC CAGR over 10 years with a 2.8. That's a 2.8, outperformance, 2.8x outperformance of swap BTC. But if you're holding a 2 NAV instrument, you're going to need the NAV to be at 2 in 10 years to realize that full 2.8x outperformance. If you're racing against a collapsing NAV, but actual outperformance of BTC through leverage, that's a tough game to play. So I don't know exactly how this is going to play out. I suspect the way I would do it is I would do ever increasing leverage. So I would go at like a 10% leverage ratio and pin it to some sort of volatility. And then amp up the leverage as I see fit to increase the viable premium over time and reward the shareholders for getting in early. That's how I would do it. So in 10 years, I'd like to be at a 50-60% leverage ratio on BTC to justify that high premium. Whereas now I'd be at like a 20% leverage ratio, right, with the Prefs. A 50% leverage ratio with the Prefs. I'll say this next. MSTR amplifies through, so here you go, leverage ratio 50%, 22.5x outperformance, BTC ARR 13%, 30%, so ARR is 30%, so we'll use this. And so this is really the whole game. But you can't lever the Prefs 50%. I know people are saying you can. You just can't right now. Like, I don't think you could go out. Let's say strategy had the option right now to lever the Prefs. I mean, they'd buy so much Bitcoin if they levered the Prefs 50%, it'd be fine. What I find to be a problem when you look at 50% leverage ratios on the Prefs is the liquidation preference, because when you think about Bitcoin per share, which is inherently what do you own in the case of liquidation, that's exactly what Bitcoin per share is, because you don't get returned the Bitcoin per share, right? So it is you think about it in a liquidation event, it's like shareholder equity. Like, there's so many, it's like net asset value for a book value for a company, right? You don't get returned the shit that the company owns necessarily, but in the case of bankruptcy or them ceasing to exist, what are you entitled to as a shareholder? That's the kind of how you value the actual corporation, or how we are. Now, you have to consider that it's a high-performing, pristine collateral asset, so there's obviously premiums associated with that. But the point I'm trying to make is, if the preferred equities represent, in the case of liquidation, a claim over the BTC, that's the same as Bitcoin per share. Like, there's no difference. The difference between a common equity and a preferred equity are the voting rights that the common has. And you could say the performance, but now you have a moving liquidation senior preferred equity. So I don't get, I just don't get how you could lever 50% on the Prefs, which would mean 50% of the total Bitcoin is covered by the liquidation preference. It's essentially covered, right? I like that terminology. And let's say Bitcoin drops 50%. If that were to be the case, then now the Prefs, assuming they don't fall in value as well, which you can't assume, but this is just a worst case kind of, scary scenario. If the Prefs stay constant, then the Prefs represent the entirety of the Bitcoin stack. And if that were to ensue, if that were to happen, I mean,
Market data connection lost.
You can make the argument that the prefs never come due.
Market data connection re-established.
Sorry, this is super annoying. You can make the argument that the prefs never come due, but if the entirety of the Bitcoin stack is covered by
Market data
liquidation
connection
preference,
lost.
I mean, at that point, you can't sell equity to pay the dividends. So
Market data connection
Bitcoin.
re-established.
But yeah, I mean, that's just such a mess. Like it's just such a mess. So
market data connection lost.
Dude, this is so annoying. I really think I'm kind of on dark side's team. I think you got to sell a little bit of Bitcoin or hold some reserves for dividend payments, just in case of whatever the market brings you. And then, like, I think you should have to maintain a 30% leverage ratio with static liquidation preference. If I were to design these preferred equities, perpetual preferred equities, I mean, you can't reward the preferred holders more so in favorable terms than the common, because all the common is a future claim on the assets of the corporation. It's a call off on the assets of the corporation. Like, we know this, right? We absolutely know this. And so you're looking at the return of the assets over which the common may have a claim in the future. But if you now have these senior equities in the capital structure, like, it's just weird to me. So, sorry, I'm rambling. Next, atmosphere have the intelligent leverage. Yep. Trades at a premium. Totally. Like, I think this is super valid. Passive flows, super valid. Institutional access, super valid. Credit amplification, super valid. I think that's the most important one, the leverage. Options advantage, that won't last long if the volatility is not. Well, the options advantage is, do you have durability and volatility? And durability is the most important thing. Like, when strategy had a 75, 80 vol, but you understood there was a floor in the Bitcoin price, or in the Bitcoin held by the corporation, you could bet on it in cool directions because you knew there was a floor and it's durable. If you're a Bitcoin believer, then you can just like sell covered calls with impunity and collect a return, or you can go long with leverage, or you can sell puts, you thinking there's a certain price at which you'd love to buy the Bitcoin. So there's a lot of cool ways you could do it. IBIT options are kind of taking the stage. They're kind of expensive, actually. Now let's talk actual options on the pref. So this is my Black Scholes modeling for December and January pref expirations, and they're good. These prices are kind of what we're seeing. They're pretty expensive, so what I say, call $3 for the 120. I mean, this is actually pretty close. It's using 26% annualized vol on Strive. So this is pretty close to the current pricing, kind of the bid on, the bid spread's like $4 on half these things, but close to the bid on Strive. And what's going to be interesting are the incentives of the holders of Strive to interact with these options and how that will change the pricing. Because the Black Scholes, you can't price these things with the Black Scholes. Like, you just can't, okay? Like, the probability it does this. And it also comes down to the corporation, what they're willing to do. I think, so you know how I talk about this crazy scenario where Stripe trades up super high? We're going to be able to look at the options chain and look at kind of the clustering and the pricing of these different securities and risks. And we'll determine how likely, what the market's pricing the likelihood of kind of a run up in Stripe to be, which I don't, obviously they don't think it's that likely. But point being, options market, super important. I'm gonna get into a couple strategies that you can employ for yourself right now in the options market. First one being, you can build a call, and this is going to create a natural arbitrage with a put and going long the equity, right? So you can buy a put. You can see the payoff diagram here of the put, which is in dotted lines. You can buy the underlying security, and then you create the payoff in blue. And I think I did these lines a little bit wrong, so excuse me for my, just graph, but that's generally the idea. And what you're creating is the put. So you buy the put. So at the money there should be put call parity unless or an arbitrage exists. But if you buy this put and go long the actual equity, you're collecting the dividends of the equity while you're holding the put. So the puts are going to naturally be more expensive because you can construct this call option while getting paid the dividends. So the puts will just be more expensive than the calls, right? And that's going to create opportunity for put sellers to enter the market and lock in a premium. So that's another way you can think to play this options chain. Is, let's say Strife has a 9% yield currently. You may decide that the puts are expensive because of this natural arbitrage here, and you're willing to enter Strife at $115. So you're cool selling $110. So you sell a put for $110 for the duration of, you want to line it up the dividend payments, or right before dividend payment theoretically, but you buy that put or you sell that put, and now you've collected a premium, which is essentially a guaranteed return. Being obliged, now you're obligated to buy the security at a certain price, which locks in another perpetual yield for you. So you're getting a kind of a heightened yield depending on the options prices, the put prices, over the actual yield, and then having a worst case yield into perpetuity once you enter. So that's a cool way to create a strategy. Now you also have the covered call strategy where you own the underlying, you get paid the coupon, and then you collect the upside premium. So you're essentially locking in more premium than you would just the actual dividend payments. And what I think is cool about that, well, one, I think it provides sell pressure on the call. So I was originally looking to go into the calls because I don't want to hold a monster position in Strife, even if I think there's a scenario in which Strife trades up aggressively. I'd rather own the chance, the probability that I think is underweighted, that it does move aggressively to the upside. So I was thinking about buying some Strife calls, and I'm going to own a very, very small amount of Strife calls, like extremely small, to hedge against this tail scenario. But the point being is all the natural pressure, I think, for the owners of Strife will be the sell calls, because you want to lock in extra like if you have Strife, you want your yield. It depends how long out your time horizon is, but you're just enhancing your yield with running the risk that it gets called away. But you may not care that it gets called away, and you just enter stretch. So I think there's going to be a lot of natural sell pressure in the call market. So we talked about put selling, call buying. And call buying is, or put buying, right? You can buy a put, hedge out your risk to the downside, and then lever up the trade depending on your cost of capital. And that could be another way to realize significant price appreciation or coupon payments or principal appreciation above just holding one-to-one spot. Again, that begs, it means there's a demand for those puts. So I think there's going to be real demand. Obviously, the selling the puts is a great strategy too, so that'll put downward pressure on the price of the puts. Maybe it evens out, but it seems like the puts are going to be kind of where it's at in this market. And then if the calls get cheap enough, a prudent individual may buy the calls based on the bet they think, or the way they think the market's going to move. Bitcoin volatility, low as ever. MSTR volatility following the same trend. Good to watch. And this is our performance on Stravera Capital. It's actually, this pulls from our IBKR account, and it shows performance. We won't show positions to anyone other than our LPs. LPs will have full access behind a login to our actual positions in real time. This does show the real time performance. I must have coded it wrong or not hosting it right because it's not updating right. It's not auto updating right now. Don't worry, that's just a problem on my end. That's no one else's problem. I just put this together in the last 20 minutes. So this will be a public facing kind of performance track record. Our investors have secure logins into our NAV portal. NAV is the same fund accounting software used by Galaxy Digital and other large institutions. So, they get to see positions, audited reports. We're fully audited. We brokerage at Interactive Brokers. We bank with JP Morgan. And this is just kind of the outward facing interface that hopefully will be helpful for people watching us as we operate in real time. And then monthly letters, quarterly reports. That is all good. August newsletter up on our website as well. You'll be able to see our thoughts and the way we're positioned. It's all good. It is all good. Thank you for watching. Hopefully this video has been informative, a little bit longer than I had expected, but looking forward to seeing everyone in New York and catching up soon.